Is the euro heading towards its biggest crisis in years? Inflation across the Eurozone is starting to spiral out of control. The latest numbers are sending shockwaves through financial markets and ordinary households alike. In Bulgaria, the newest member of the Eurozone, inflation has already surged to 7.1%. Croatia has reached shocking 5.8%. Greece is now at 5.4%. Lithuania climbed to 5.2%. Belgium, one of the richest countries in Europe, has risen to 4.07%. Ireland now standing at 3.6%. Slovakia reached 3.5%, and Estonia and Portugal are both at 3.4%. It is much more than the interest rate. That means the euro is going down. Inflation has also jumped sharply in Spain to 3.2%, and Germany has climbed to 2.9%. Italy is now at 2.8%. These are no longer isolated numbers. They are warning sign that prices across Europe are accelerating out of control, and the situation becomes even more dangerous because all of this is happening while interest rates remain extremely low. Millions of Europeans are now watching the real value of their savings disappear month after month. The euro is buying fewer goods and services every single day. More people are starting to realize that their money is silently losing value. More and more analysts now believe the European Central Bank could soon be forced to raise interest rates aggressively. If the ECB fails to act, an even more dangerous scenario could unfold. Confidence in the euro itself could begin to collapse, and it is collapsing. People may start dumping the currency in panic. They could rush to spend their money or move it into other assets before inflation destroys even more of its value, like to gold. And that panic could push inflation even higher, while at the same time destroying the purchasing power of the euro even faster. Is Europe standing on the edge of new financial crisis? And why could the European Central Bank soon find itself trapped with no easy solution left? That's exactly what we are breaking down in today's video. Inflation is once again becoming one of the biggest economic fears across Europe. Consumers in many Eurozone countries are noticing sharp increase in the price of the food, housing, transportation, electricity and everyday services. In countries where inflation is rising the fastest, public frustration is starting to grow rapidly. In Bulgaria, where inflation has surged above 7%, many economists are warning that households are losing purchasing power at an alarming speed. Bulgarian media outlets are increasingly discussing the fear that wages are no longer keeping up with rising living costs. In Croatia, inflation above 5% has become a major political topic. Citizens are complaining about rising supermarket prices and higher tourism-related costs during the summer season. In Greece, memories of the previous debt crisis are making many people nervous about another period of economic instability. Greek analysts are warning that prolonged inflation could seriously weaken consumer spending and economic growth. Lithuania and other Baltic countries are also facing growing concerns about energy prices and the overall cost of living. Across many smaller Eurozone economies, people are beginning to question whether the European Central Bank reacted too slowly. The ECB continues to say that it is closely monitoring inflation developments across the Eurozone. Officials from the European Central Bank have repeatedly stated that price stability remains their primary objective. However, investors are increasingly expecting the ECB to eventually raise interest rates further if inflation continues accelerating. Some ECB policymakers are warning that inflation risks may become more persistent than originally expected. Others are worried that keeping rates too low for too long could could damage confidence in the euro itself. In Germany, inflation has become a major national issue once again. German media frequently discuss rising food prices, expensive housing, and increasing pressure on middle-class households. Many Germans are particularly sensitive to inflation because of the country's historical fear of currency instability. Some German economists are openly calling for the stricter monetary policy and faster interest rate hikes from the ECB. In Spain, inflation is heavily impacting families through higher electricity bills, food costs, and rent prices. Spanish consumers are increasingly worried that salaries are not rising fast enough to offset inflation. Economic commentators in Spain are debating whether aggressive interest rate hikes could hurt economic recovery and increase unemployment. In Italy, concerns are growing about the impact of inflation on public debt and consumer confidence. Italian businesses are warning about weakening purchasing power and showing domestic demand. Some analysts fear that higher interest rates could create serious pressure on highly indebted Eurozone countries like Italy. Across Europe, there is now an intense debate about what the ECB should do next. Rises rates too slow, and inflation could continue spiraling upwards, rise them too aggressively, and Europe could face slower growth, weaker investments, and possibly even recession. This is why many economists believe that Eurozone may be approaching one of its most difficult economic balancing acts in years. One of the biggest problems facing Europe right now is that wages are not increasing fast enough to keep up inflation. In many Eurozone countries, people are working just as hard as before, yet their money is buying less every single month. Families across Europe are starting to cut spending on restaurants, vacations, electronics, and even basic household items. Consumer confidence is beginning to weaken in several major economies. Retailers in some countries are already reporting slower demand as households become more cautious with spending. Economists warn that this creates a dangerous cycle for the economy. When inflation rises too quickly, people are losing purchasing power. When purchasing power falls, consumers spend less money, and when consumers spend less money, businesses begin earning less revenue. That can eventually lead to slower hiring, weaker investment, and rising unemployment. In Germany, some manufacturing companies are already warning about weakening demand both inside Europe and globally. Germany's export-driven economy is especially vulnerable if consumers across Europe begin cutting spending aggressively. In Spain and in Italy, many small businesses are struggling with higher operating costs. Restaurants, transportation companies, and local retailers are paying more for energy, supplies, and wages, but many of them cannot fully pass the cost out on consumers without losing businesses. Across Europe, housing costs are also becoming a growing concern. Higher inflation combined with potential interest rates hikes could make mortgages significantly more expensive. Younger Europeans are increasingly worried that home ownership may become even more difficult in the coming years. Financial markets are now closely watching every statement coming from the European Central Bank. Investors are trying to predict how aggressively the ECB may raise interest rates in the month ahead. If rates rise too quickly, borrowing could become far more expensive for households and governments. Several Eurozone countries already carry enormous level of debt. Higher interest rates could dramatically increase the cost of servicing that debt. This is especially concerning for countries like Italy, where government debt remains extremely high. Some analysts fear the euro could eventually face a debt pressure crisis at the same time as high inflation. That combination would create a very dangerous economic environment. Meanwhile, ordinary Europeans are becoming increasingly frustrated. Many people feel that official inflation numbers do not fully reflect how expensive daily life has become. Food prices, insurance costs, rent, utilities, and transportation continue rising in many cities. Social media and public debates across Europe are increasingly filled with concerns about the declining value of money. Some people are beginning to move savings into gold or silver, even real estate or foreign countries to protect themselves from inflation, and if confidence in the euro weakens further, that trend could accelerate even more. Around the world, growing inflation inside the Eurozone is starting to raise serious questions about the long-term stability of the euro. International investors are closely watching whether the European Central Bank can still control inflation without damaging economic growth. For years, the euro was viewed as one of the world's safest and most stable major currencies, but rising inflation is beginning to weaken that image. Financial analysts in the United States and Asia are increasingly discussing whether Europe is entering a prolonged period of economic weakness. Some foreign investors now fear that the ECB may be trapped between fighting inflation and protecting heavily indebted Eurozone economies. If the ECB raises interest rates aggressively, weaker economies inside Europe could come under severe pressure, but if rates stay too low, inflation could continue eroding the value of the euro. This uncertainty is creating growing concerns in global currency markets. Some central banks outside Europe are becoming more cautious about increasing euro reserves. Instead of heavily expanding euro holdings, several countries are increasingly diversifying into other assets. Gold has become especially attractive once again as the central banks look for protection against inflation and currency instability. Central banks around the world have been buying large amounts of gold in recent years. Many governments see gold as a safer, long-term store of value during periods of global economic uncertainty. At the same time, China is continuing efforts to strengthen the international role of the Chinese yuan. Some countries are gradually increasing trade settlements and reserve holding in yuan instead of relying entirely on the euro or dollar. Nations involved in closer economic cooperation with China are especially exploring alternatives to traditional Western currencies. In parts of Asia, the Middle East and Africa, discussions about reducing dependence on both the dollar and the euro are becoming more common. However, the euro still remains one of the world's largest reserve currencies. Many countries continue holding significant euro reserves because Europe remains a massive economic and trading bloc, but confidence is no longer as unquestioned as it was once. Investors are increasingly demanding proof that the ECB can restore price stability. Currency traders are also paying close attention to inflation differences between Europe and other major economies. If inflation in the Eurozone stays persistently higher while economic growth weakens, the euro could face additional downward pressure in global markets. Some economists warn that long-term damage to confidence can be very difficult to reverse once investors begin doubting a currency's stability. This is why the ECB is under enormous pressure to convince both Europeans and the rest of the world that inflation will eventually come back under control. But it is not happening at the moment, because if trust in the euro continues weakening internationally, Europe could face not only an inflation problem, but also growing credibility crises for its currency itself. If inflation across the Eurozone continues staying near 5% or even higher in some countries, while the European Central Bank refuses to significantly rise interest rates, the consequences could become extremely dangerous for the European economy. The first major risk would be a continued collapse in the purchasing power of the euro. Ordinary Europeans would notice that their salaries and savings buy less and less every month. Food, rent, transportation, healthcare and energy prices could continue rising much faster than wages. Millions of households could slowly become poorer despite still having jobs and stable economies on paper. Saving accounts would become especially vulnerable. If interest rates remain very low while inflation stay above 5%, people holding cash in banks would effectively lose value every single year. In some countries, real losses on saving could become severe over time. This could push more people to panic and spend money quickly before prices rise even further. But that behavior itself could make inflation even worse. Economists call this as inflation spiral. Once consumers lose confidence in a currency future value, they begin spending or moving money faster. That increases demand across the economy, and stronger demand can push prices up even more aggressively. At that point, inflation becomes extremely difficult to control. Another major danger is the loss of trust in the European Central Bank itself. The ECB's primary mission is to maintain price stability. If inflation remains far above target for too long, many people may begin believing the ECB has lost control of the situation. Financial markets could also start reacting more aggressively. Investors may begin selling euro-denominated assets if they believe inflation will continue eroding returns. That could weaken the euro even further against other global currencies. A weaker euro would then make imports more expensive for Europe. Europe imports enormous amounts of energy, raw materials, electronics, and industrial goods. If the euro weakens significantly, import prices could rise sharply, and that could fuel another wave of inflation across the continent. Countries already struggling with the inflation above 5% could face even faster price growth. Social tensions could also increase dramatically. Public anger over rising living costs may lead to protest, political instability, and growing support for anti-establishment movements. Governments across Europe could come under enormous pressure to increase spending and subsidizes. But increased government spending could also worsen inflationary pressure even more. Businesses would face growing uncertainty as well. Companies struggle to plan investments when prices, wages, and financing conditions become unpredictable. Some firms may delay hiring or expansion plans entirely. Foreign investors might also become more cautious about investing in Europe if inflation remains persistently high. In the worst-case scenario, Europe could enter a period of stagflation. That means high inflation combined with weak economic growth and rising unemployment. Stagflation is considered one of the most difficult economic crises to solve because rising rates hurt growth, while keeping rates low fuels inflation further. And if inflation remains above 5% across multiple Eurozone countries for an extended period, pressure on the ECB could eventually become impossible to ignore. Another major consequence of rising inflation inside the Eurozone could be a growing reluctance among European Union countries that still have not adopted the euro. Countries like Poland and the Czech Republic and Sweden may become even more cautious about joining the common currency in the future. For years, supporters of the euro argued that the currency offers stability, security, and protection against economic shocks. But persistent inflation above 5% in several Eurozone countries is beginning to challenge that perception. In Poland, public skepticism towards adopting the euro could increase even further if inflation inside the Eurozone continues accelerating. Many Polish economists and politicians already argue that maintaining control over the national currency gives Poland greater flexibility during periods of economic uncertainty. Instead of increasing exposure to the euro, Poland has recently focused heavily on expanding its gold reserves. In May 2026, Poland increased its gold holdings to approximately 595 tons. It's almost 600 tons. That move strengthened Poland's position as one of the largest gold holders in Europe. Gold is increasingly viewed by many countries' banks as a strategic asset during periods of high inflation and currency instability. By increasing gold reserves, countries can reduce dependence on foreign currencies whose purchasing power may weaken over time. Some analysts believe Poland's aggressive gold accumulation sends a broader message about growing concerns regarding long-term monetary instability in Europe. In the Czech Republic, skepticism towards adopting the euro has also remained strong for years. Czech policymakers often emphasize the importance of maintaining independent monetary policies through the Czech crown. Rising inflation across the Eurozone may reinforce arguments that giving up monetary sovereignty could expose countries to greater external risks. Sweden has also continued avoiding euro adoption despite being a member of the European Union for many years. Swedish officials frequently highlight the benefit of controlling domestic interest rates and monetary policy independently from the ECB. If inflation problems inside the Eurozone worsen further, support for keeping the Swedish crown could strengthen even more among the Swedish public. Across Europe, central banks are increasingly rethinking how they structure national reserves. Instead of relying too heavily on a single foreign currency, many countries are diversifying reserves into gold and other assets. This trend has accelerated globally in recent years as concerns about inflation, debt, and geopolitical instability continue growing. If confidence in the euro weakens further internationally, some non-EU countries may slow down or completely freeze discussion about future euro adoption. That could become a major political and symbolic problem for the European Union itself, because the euro was originally designed not only as an economic project but also as a symbol of deeper European integration. And if neighboring EU countries increasingly prefer gold reserves and monetary independence over joining the Eurozone, it could signal declining confidence in the long-term stability of the common currency.